Hey, ladies and gentlemen, it's Jason with Coldwell Banker High Desert Realty, and I'm here with your April 2019 edition. And get ready for your monthly market report. And so I'm going to jump right in. And, April is always the month that we're going to be looking at pricing in the overall market. And that's because a lot of reports come out. First off, let's look at the existing home prices. There's a monthly report that comes out from the National Association of Realtors, and we can see that prices are up pretty nicely year over year across the United States. But the United States as a whole has dropped down to about 3.6%, which is actually normal appreciation. If we look back over time, historic appreciation is about 3.6%, and it looks like that's where we're going to be for the foreseeable future. There are some that think the pendulum is going to swing a little too far one way, and you might drop a little bit below 3.6%. And then there's another group of people that are saying that we've had such a great start to 2019 that nationally they might actually change the projections going upward a little bit. So they're projecting that maybe appreciation might be a little stronger than what they originally talked about, but we're going to touch on that here in a few seconds. So year over year, the FHFA report comes out and they break down by region, so you can know exactly where you're going at on year over year pricing by region. And we can see that there's still strong appreciation throughout the country. There is no part of the country that's experiencing depreciation, and most definitely, but not really weak depreciation. But most definitely no depreciation, but some areas are having some weak appreciation. And then we have the year over year price changing from CoreLogic. And what they're showing is that there's two states, Louisiana and North Dakota, that did see minor depreciation over the last year, but the rest of the country is still very strong. And looking at what's going to be happening as we move forward, you can see the forecasted year over year percent change in price. North Dakota and Louisiana are going to do just fine, along with the rest of the country. There's going to be some talk from recent blogs and stuff like that you might see that questions that 4.6% price change going forward across the country. It might uptick a little higher. And again, that's because 2019 really got started on a national level as a pretty big boom. If we look at the Case-Shiller report, and remember it's January 2019 because it takes a couple of months for them to get their data through. That's the most recent report, was from January 2019. And again, what we see is that home appreciation values have come in for a soft landing over the last 12 months, and we're really getting back to normal appreciation levels, which is what we kind of predicted was going to take place even 12 months ago. So we're coming into 2019, and prices are going to slow down on their appreciation a little bit as inventory levels continue to rise. The balance between inventory and demand was going to come much closer through 2019, and therefore prices were not going to continue to shoot up at that 6 and 7% as we had seen recently, and we're going to go back to more normal appreciation. Also, just what came out was the Home Prices Expectation Survey. They showed a panel of 100 economists, real estate experts, and investment and marketing strategists. And they gave us exactly what the breakdown has been. And that's where we get the numbers for the historic appreciation. According to the pre-bubble, we're talking about 1987 to 1999 here, the appreciation in this country on a basis was about 3.6%. During the bubble, the appreciation almost doubled to 7.1%. And then obviously when the real estate market bust from June 2007 to February 2012, prices, on an annual basis dropped by about 6%. The good news is that since the recovery, kind of going March of 2012 to December of 2018, the last month they recover, the last month that the report covers, the appreciation rate has been 6.2%. So that's what we're seeing, and we're getting back to a very normal market situation. what they're projecting moving forward is that cumulative appreciation by 2023. If we take a look at the 100 projections from this home price expectation survey, we can see that, what they think that is going to be happening during that time, that home values on average are going to go up 17.1% between now and 2023. The most optimistic 1/4 of those surveyed, those are in the dark blue over there, think that we're going to have a real strong appreciation over the next 5 years, saying about 28.3%. But even the bears, the ones who are most conservative, the most conservative 1/4 of that survey, I think they're going to go up, and that they should go up by about 6.6%. Now, if we break it all down again, the home price expectation survey year by year, we can see that we think that 2019 is going to be a very strong year at about 4.3% appreciation. And then it's going to balance out as we make our way down to 2023. The pendulum might swing a little bit off of that 3.6%, and that's where we're projecting 2.8% appreciation for 2020. And then it's sneaking back up to that 3.5, 3.6% norm as we move towards 2023. Now, the interesting thing is, if you look at the blue column, this is where the latest report was predicted. The gray column is what these guys, these 100 economists and such, predicted a year ago. And that was, a year ago, the fourth quarter of 2018. As you can see, for 2019 and 2020, they've actually raised the projection of where home appreciation, where they think it's going to go. They think that the market is doing better, and they're starting to see, that demand is up. Inventory is, coming to bear on the market, but it's selling off quickly. So they don't have to drop those numbers from what they saw last year. They're actually increasing those numbers. So let's take a look and see across the home expectation survey, Zelman and Associates, the Mortgage Bankers Association, Freddie Mac, the National Association of Realtors, and Fannie Mae. Each one of them projects, what their projections are going out for as long as 4 years. And we can see that there's no red numbers in there. There's no depreciation projected by any of the major outlets here. And we can see that, we're going to do relatively good in 2019, above norm. Then we're going to settle down to a more normal transition as we go into 2020, marching towards 2023. But usually it takes for the appreciation for the home expectation survey is saying that it's going to be good, great numbers. And this is something that we want to leave you with. Realize the financial benefits of owning a home, and using these numbers from the home expectation survey, you can see that, someone who still bought a house in January of 2019, where the expected appreciation is to go over the next 5 years. If you bought a $250,000 house in January of 2019, we're looking at a $42,000 increase in the value of your house over the next 5 years. So, that's really just financial benefits of owning a home. And even though the appreciation will be slowing, it's still a great time to buy over the next 5 years. You look at the amount of appreciation people are going to have, it's just insane. Now, National Association of Realtors just came out with a report looking at not only a price appreciation, but as people pay off their mortgage payments over 5 years. And they went, they went to 5, 10, 15, and 30 years. And look at the appreciation gains that goes on. You can see where the equity for these folks is going to be. This is where families are going to build wealth. You see that first house on 5 years, they're looking at $64,000 of appreciation over the next 5 years, and they've paid their mortgage down $15,000. That's almost an $80,000 appreciation or equity build over the first 5 years. Now, just remember that renters, the average family, doesn't get to build their wealth the same way. And so that's something that we should really just be paying attention to, is that renters is going to be probably around $6,000 of equity growth in this time, or of their net worth growth, where homeowners are enjoying the value of their properties going up. Now, what is that doing? Let's take a look here. Here's something that's pretty interesting. People are starting to worry, can you really still afford a house? And does it look like a good deal? Well, I want you to understand that this affordability crisis that people are talking about has a lot to do with what's going on in the rental market, because rental prices keep going up. If we take a look at the percentage of income required to rent, and we go as late as the 80s and 90s, we can see that the percentage of income required today compared to previous, it's significant. It's still more significant than even owning a property. So let's take a look at what NAR says, because the breakdown of the actual month-to-month basis going all the way back to June of last year, the percentage of income required to make a normal mortgage payment has dropped significantly. As wages go up, because, as they say, as interest rates go down, as prices modify, we are cheaper to own a house at 16.1% of your income now than what the normal historic average is. So that makes buying a house still a pretty good deal for folks when it compares to renting. So now, the U.S. home ownership rates are starting to take a turn, and they're heading upward. For the last 8 quarters, the percentage of people who have owned a home has increased. That's 2 years in a row that percentage has gradually been going up there. Each quarter for 2 years in a row, it's increased. Now, it fell off dramatically during the housing bubble, and I think all of us can understand that. But it's really turned around, and that's not just for 1 or 2 quarters. That's really for the last consecutive 8 quarters. Home ownership rates for U.S. percentage of the age under 35, that percentage from the first quarter to 2017 to the fourth quarter of last year, those are the latest numbers available. We can see that number jumped up. So millennials are the generation that believes, or are still a generation that believes, that home ownership is part of the American dream. And we're seeing more and more millennials coming into the market. They are not the rental society or the rental generation that some people made them out to be. And they are really starting to come to market in a big way. As a matter of fact, a recent survey showed that 66% of millennials who rent are determined to buy a home. That's a great number, because that's also the largest population growth that we're going to be seeing since the baby boomers. As a matter of fact, a recent survey showed that of the 66% of the millennials that wanted to buy a house, Pulseonomics did a survey of renters. Renter millennials who rent and are determined to buy a home. When we look at that, what's your ability to afford a home in the future? 56% said that they were confident they would be able to buy a home in the future. 30% said they were somewhat confident. So that's 86% of the millennials are either confident or somewhat confident that they're going to be able to afford a home in the future. So let's get to that affordability index, or that affordability crisis challenge, and let's get that out of the way. Homes are still very, very affordable. And there's a lot of headlines out there and stuff like that, but the data is just not supporting what we're seeing out in the news. The affordability crisis has a lot to do with the rental market, not so much with the home ownership market. So if we go back to that Pulseonomics survey and ask a slightly different question, and that question was, when do these renter millennials plan on buying a home? 10% said they wanted to buy a home within the next 12 months. And, there was another 30% that said they wanted to buy a home within the next 12 to 24 months. Now, that's 40% of millennials, renter millennials, that plan to buy a house in the next 2 years. And if you add that to the 33% that said they wanted to buy a home in the next 3 to 5 years, we're now talking about 73% of the millennials that are renting a home right now plan to buy a home within the next 5 years. This is really just showing that the millennials are not the rental generation. They believe in home ownership as much as generations, if not more, that came before them. And the biggest challenge is that they've had inventory that they've had to limited inventory that's prevented them from renting. So if we look at the lower end of the market, which is considered in most parts of the country to be between $200,000 and $400,000, we can see that a lot of new family homes are being built in that range. And we can look at the first quarter of 2019 versus the first quarter of 2018, where the number jumped from 51%, which is basically one out of every two homes that was being sold was a new construction. Now new construction is jumping 2 out of 3 of the homes that are being sold. But realize with more new construction coming into play, sellers have to think, and this is actually from Danielle Hale, who's the chief economist at Realtor.com. Sellers have to think about the competition in a way that they haven't before. Getting ahead of other potential sellers can be an even bigger advantage this year, given market conditions. So what this is saying, well, they're saying that there's going to be more new construction coming to market. Sellers get ahead of that. You'll get a better price if the competition, if you beat the competition out before the new construction is already out there. And as always, we want to give you a lot of good information on pricing as it's kind of broken down. That being said, a couple of things just to look at. What is the average days on market for homes? And we can see the average days on market in the United States is 44, which just is something that kind of shows there's not a lot of inventory out there and that buyer demand is very, very strong. We can see that existing home sales, particularly in our region, which is the Western region, is down almost 9% from what it was year over year. And that's, again, just because there's a lack of inventory out there. So that's being very, very frustrating. If you're a buyer in this type of market, maybe it's not the best time to be really fickle about home inspections and stuff like that if you're serious about getting a home. If you're a seller on this type of market, you definitely want to recognize that inventory shortages are bringing a lot of buyers to look at your house. New home sales, this is a graph that has changed recently over the last year or so. All the new home sales about a year and a half ago were all in the $500,000 plus range. We're seeing a lot of builders getting on board. Now we see that 37% of the new homes are being built between 200 and 300,000, which is a significant shift from what we saw just 12 months ago. New homes are selling fast. You can see that we are floating at about a 3.4 months is what it's taking the average new home to be constructed and be sold. Let's see, pending home sales year over year, just a little bit of information. You can see that the pending home sales in the West is down almost 11%. And again, what's really preventing our region from taking full advantage of this market is the lack of inventory. You can see that distressed properties have been almost non-existent. It's only making up about 4% of what's being sold right now. What you just want to be aware of that is if you're an investor, you're thinking you're going to do a fix and flip, you just need to understand that it can be very, very difficult to find those types of properties right now. They are almost non-existent in the current market. Let's take a look at some housing inventory numbers. We can see that across the nation, seller traffic is very weak. That's what's actually causing any delays in buyers finding homes right now. The buyers are out there. The months of inventory that are for sale, you can see how these numbers have dripped off and are even lower today than what they were just a quarter ago. You can see that the months of inventory of homes for sale is still well below that 6-month average. 6 month represents what's considered a balanced market for buyers and sellers. Less than 4 months is what's considered a seller's market, and we're still firmly in a seller's market. Let's see, here we are, just to give you another example. The last 12 months, we've dropped down to a 3.5% months of inventory. Again, that's firmly in a seller's market, and that just, if you're a buyer, you want to be cognizant that there's not a whole lot of choices out there, and because there's so many buyers out there looking at this limited inventory, if you're a buyer and you're being really, really picky, you may not be getting into your house right away. Mortgage rates, always something to know, because last month when we had talked about mortgage rates potentially going up significantly by the end of 2019, and it looks like the mortgage rates have balanced out. Currently a Freddie Mac 30-year fixed rate is looking at about 4%. We can see historically, going all the way back to 2016, that rates are actually significantly lower than where they were just about a year ago or so. We can see that everybody's pretty much thinking that mortgage rates are going to be balancing out. This includes Freddie Mac, Fannie Mae, National Association of Realtors, and the Mortgage Bankers Association. Looks like by the end of the year, we're going to be probably about 4.5% mortgage rates, which is actually a better predictor than what we saw last month, where they were predicting them to be about 5% by the end of the quarter or by the end of the year. Mortgage rates have been going up slightly, and they're expected to go up as we move into 2020. But for right now, it looks like for the remainder of the year, we're going to be floating between about 4 to 4.5% on the mortgage rates is what we're seeing. Mortgage credit availability. This is always a big question because a lot of buyers disqualify themselves before they even look. And here we can see that mortgage availability has really skyrocketed since 2013, but it's nowhere near what it was during the real estate bubble and bust. Just so you know, mortgage rates it's still pretty much historically normed at what the availability for mortgages is right now. Average days to close a loan across the United States is about 47 days from the time that the property goes under contract to the time that it's closing. And that's actually pretty consistent with what we're seeing here in the local market as well. This is a big one for you buyers out there. A lot of buyers think they have to have a 750 credit score or higher to qualify for a loan. And what you guys can see from this graph, over 53% of home buyers who got into their loans actually had less than a 750 credit score. So don't automatically discount yourself just because you don't have an 800 credit score. All right, and so for our last slide here, guys, we can see that the average FICO score for all loans was about 726, and for our first-time home buyer loans like FHA, the average credit score was actually 675. Now keep in mind that that's the average. Half of those were a little bit less than that, and half of those were a little bit more than that. The end statement is, guys, the real estate market right now, inventory levels are low. We're seeing that especially in the local market, and you just want to be a savvy buyer if you're out there and recognize that. If you're a home seller, understand that having your property ready to sell is going to be uber beneficial. Making sure that your buyers are informed about the process and such like that. Getting your home inspections done up front can really cut that marketing time and that time on market down a little bit. So anyway, guys, this is Jason with Coldwell Banker High Desert Realty. This is your April 2019 market update report. Please, please, please let us know what's going on. If you need more information than this, absolutely give a call to our office, and we'll talk to you again next month. Talk to you later. Bye-bye.